Hi, everyone, and welcome to our webinar on apartment insurance. My name is Jacob Cole. I'm the marketing coordinator here at CID. Today, Michelle Belden, our habitational underwriter, will be sharing her expertise and helping you better understand how to insure your apartment risks. She'll be going over the specific learning objectives in just a second, but before I pass it off to her, I wanted to quickly go over the logistics of this webinar. As you can tell, you're all muted, but there is a chat feature, so you can type your questions in at any time and we'll answer them throughout the webinar. Also, a short survey will pop up after the webinar so you can help us improve these webinars for you. So we appreciate you taking the time to fill that out. Without further ado, I'll pass it off to Michelle.
Thank you, Jacob. Hi, everybody. Welcome to our webinar. I am Michelle, as Jacob said. I'm just going to go over a few things that we're going to talk about today, and then we'll get into the meat of everything. So we're going to first dive into the thing that most people want to know, what's happening in the apartment and dwelling industry, all the changes that are happening, how it affects remarketing your risk, non-renewals, all of that. So we'll cover that in detail. We're also going to go over the types of residential buildings and the coverages they need, as well as understanding underwriting guidelines through actual examples. So we have a couple examples that I'll, kind of explain to you, like when I'm going through it and quoting the risk, what we're looking for. Then our last two parts of this webinar will be about what's needed to get a quote. And then once we get past that quote and we're ready to bind a policy, what's needed to bind that policy and any post-bind requirements that come with that, just so everybody, knows the whole process from beginning to end. All right, so industry changes. I know that's why probably most of you wanted to come today. As we all know, we're in a very hard market right now, and it's not changing anytime soon. And it's been a struggle for everybody, for you as the retail agents, for me as the wholesaler, and then same thing with the carrier. Everybody is either scaling back on what they're writing. Sometimes they're exiting the market altogether. I mean, all of our California agents are really aware of how many carriers have left California, not only because of losses, because of the wildfire, for many factors. So it's a very hard market that we're in, and it's causing difficulties for everybody to find replacement coverage for their insureds, or to help a new client find coverage. So some changes that we're seeing that you are all probably all aware of, but we'll just recap them anyways, is carriers are changing their underwriting guidelines when it comes to how old the building is, regardless of if they've had updates. So a building built in 1925 may have been completely gutted and renovated in 2020, and no carrier wants to write that building that was built in 1925 because the original year built is still 1925, regardless of those updates. We do have markets that will take the older buildings, which we'll talk about a little bit later, through some of our examples. But there are many carriers who have scaled back on their age. Some carriers are only doing 20 years, some are doing 30. There are still some out there doing older apartments, which is great, and older buildings in general. So that's still helpful, but the market definitely is getting smaller and smaller on the age side of things. Other carriers are taking caps on the number of units that they'll accept, caps on the TIV. So that can affect even the caps on number of the stories, I've seen. So depending on the risk, where it's located, and what carrier you can go to. For us, from a TIV perspective, generally we're capping out about 20 million TIV per location. That's not always the case, but that would probably be our max. If you have something a little bit larger, feel free to reach out to me, and we can discuss the specifics of that particular apartment, or any other type of building that you may be looking for coverage on. And we can see if it's something that might fit with some of our markets that can maybe go a little bit higher. But these days, 20 million is about where we've been capping out. I know there are markets that will non-renew in an area, not necessarily because of wildfire or age or anything like that. They're just oversaturated in that area, so they're concerned about having too many claims. Like in the event a wildfire came through and destroyed the whole location, like it happened in Paradise a few years ago. So I've seen carriers send non-renewals because they're like, we have too much property coverage in this location, so we need to scale it back. So we're not putting ourselves at such a greater risk, which makes it hard for the insured, because it's like the insured didn't do anything wrong, but the carrier decided to make that decision. I mean, that's how it is with most of these reasons for non-renewal and the changes happening. A lot of things are affecting the insureds negatively, but not necessarily that the insured did anything wrong. As you know, in California especially, but in so many other states right now as well, Washington, Oregon, Arizona, Nevada, New Mexico, pretty much the whole US, let's be honest, we're having to brush and wildfire map all of our risks. So that means, if depending on what their score comes back as through CoreLogic and what their distance to brush is, will affect what market availability there is. If it's a high or very high wildfire score, we will not be a market for the property, but we could still look at helping you guys with monoline GL for an apartment. So and those things, we would let you know when we're working on the risks, screening it and working on our submission for it. Let you know, hey, we're not going to have a market for the property, but we can look at that. I know so many people are turning to, especially in California, for example, turning to the California Fair Plan to get property coverage, which is great. And then I have people reaching out to me when they're getting that, asking if we can do a DIC policy. We are not a market for a DIC. So the only line that we'd be able to help with if you had to take the property to California Fair Plan would be monoline GL. We are, like I said, not writing any DIC policies. We also don't do any earthquake or flood insurance. I do get those requests every now and then, so just so you guys are aware, it's not a coverage that we write. Crime scores, those are becoming a much bigger thing. We're having to run crime scores with our carriers and input them in our system when we're quoting with them. So the crime scores are affecting where carriers are wanting to accept risks. So if you have a higher crime score, that, we'll kick it out with some markets, not all. And then we're seeing, and obviously in California, most apartment markets that we have are going to be written on a non-admitted basis. Therefore, a habitability exclusion will apply. I'm starting to see some habitability exclusions in other states as well. Sometimes it's more on a case-by-case basis in states outside of California where carriers wanting to see it. Possibly maybe they had some losses or have related losses, so the carrier is wanting to add that exclusion onto the policy, or maybe they're offering a sublimit if they're able to. But that is something, to be on the lookout for if you see it on there, to explain that to your insured, and what entails, like what kind of losses would potentially be excluded by having that coverage be excluded on their policy. And then two, for mixed use buildings, so I'm going to talk a little bit more about those on the next slide, but just real quick. So for those ones, you have got either, generally it's like commercial on the bottom, residential on top. For those ones, your commercial tenant occupancies can really dictate, the availability of a market. Some people don't like to write restaurant over hab. Just a couple weeks ago here in San Diego, restaurant fire broke out that burned the building, which happened to have apartments on top of it. So you can see why certain carriers wouldn't want to have a restaurant tenant above hab because of the potential for fire is greater. And then other types of commercial tenants, could be ineligible with a carrier. So that could be a reason it gets kicked out. So knowing that information is really important. And like I said, about splitting the coverages from the property and the GL, sometimes we have to do that just in general, not because you're taking the policy to California Fair Plan or somebody like that, but because one market of ours is like, okay, well, this is too high for us to do the property, so we'll only do the GL, and vice versa. So sometimes we're still having to split out the coverages. Even if I'm still writing both the property and GL, it might not be with the same carrier, it might not be on a package basis. And then overall, market availability is going to vary by state. It's going to vary by the risk. So, I get a lot of people asking me, oh, what markets are you going to take this to? Honestly, I don't know until I'm able to look at the risk in a whole, because there's just so many moving parts and so many underwriting changes. We get, a memo from our carriers almost on a daily basis. So trying to answer those questions are a bit hard. If you want to talk to me about risk and, give me some background, I might be able to be like, okay, yes, I would potentially have a market for it, but it doesn't necessarily mean that there's always going to be going to have an option for it, because, one day this one would be fine, and then the next day, the carrier releases a new underwriting guideline, and all of a sudden I can't quote that risk that, we talked about the day before. So like I said, it's a lot of moving parts. So the more information you guys can provide, the better, because then that really helps me be able to try to, place the business in a place where it will actually be able to stay. We're not in the business to write a policy to then cancel it. So our goal is to write it and then have it come to term so it can get renewed. I see we have a question about the habitability exclusion. Will it always apply? In California, for our non-admitted markets that we have available, habitability exclusion will apply. I don't have any carriers. I have like one that might not offer a habitability exclusion, one or two. It kind of depends, like I said, the risk. So it's kind of a hard question to answer. And especially in California, I don't expect it to go away anytime soon, just with the losses that there have been. over the years, and with ambulance chaser type lawyers and things like that. So I don't expect that to go away anytime soon, since it's been around for a bit. But you never know. Like I said, things are changing on a regular basis, so potentially it could in the future. But at this time, it's going to be pretty standard, especially in California, on non-admitted business. All right, so let's just go over some definitions of an apartment. So for me, I consider an apartment to have 5 units or more. Sometimes that could be a makeup of, multiple buildings or one building. Depending on the carrier, they might see it differently. So sometimes you could have a 5 unit apartment where you have 2 duplexes and one single family dwelling, but they're all in the same lot. So to me, that's a 5 unit apartment, because they're sharing a common area and sharing common things. Otherwise it's a single standing building with multiple units in them. And then for us, single standing 1 to 4 family dwellings. So that's, a single family home, a duplex, a triplex, or a fourplex. Those can go either commercial or personal, depending on the ownership of the building. So if it's in the name of an individual, is it in a corporation, an LLC? Generally, if it's in a corporation or an LLC, it's not something personal lines would want to pick up, because that's a commercial exposure. Though if it is in the name of an individual, like I said, it could go personal or commercial. So it kind of just depends. I know there's been a lot of changes on personal lines as well as commercial lines. We don't focus on any personal lines, so we're only doing strictly commercial. So I know I've been getting submissions for these 1 to 4 family dwellings that were on personal line policies before, but they're being non-renewed. So we're taking them commercial. So that will affect things. And then, like I was just talking about with the mixed use buildings, that's when they're both occupied by commercial and residential tenants. I have some brokers who will refer to mixed use buildings as ones that have like retail, commercial type tenants and office tenants. To me, that's not a mixed use building, because that's all strictly commercial. That's just different types of commercial. For me, a mixed use building is truly with commercial and residential. All right, so we're going to talk about some apartment coverages, what coverages you should be looking out for and providing to your insureds when you're, putting accords together and putting a submission together, and what coverages they need. And then once we talk about these coverages, we'll dive into some examples to kind of go over how these coverages apply. So for an apartment, obviously you would be wanting to look for property and GL. So property being your property coverage for the building. If they have any components, so if they have carports, fences, signs, a marquee, anything like that. Sometimes if they have a playground, people might be looking for coverage on the playground as well. So the important things, providing the appropriate building limit. I can't tell you how many times I get accords that will write building, but then not put a building limit. I have to know the limits of insurance that you're looking to quote, because I can't quote a policy without any building limits. So that information is extremely important. The business income, your loss of rents coverage, that I need. I'll have people just write ALS on there. Unfortunately, we don't offer ALS. Most of our carriers aren't offering that, and the carriers that we did have, have slimmed down on their underwriting for apartments, so it's pretty rare that I go to them. But even if we're offering coverage on an ALS basis, rarely, like I said, we still need that figure. What is that rents number? Because we have to input that information when we are quoting a risk. So I need to have the actual rents on there. So, I'll look through the accords, because sometimes people will put it on the 125 or the 126. But if it's not seen anywhere throughout the whole accords, that's information we would be asking for. Building ordinance coverages would be a supplementary coverage to also talk about offering to your insured. Those, however, only apply if your building is eligible for special form replacement cost. So if building is, we're only offer building coverage on a basic ACV basis, building ordinance wouldn't be able to be offered. So, sometimes I get a submission where they want that and it's listed on the accords, but then after reviewing the whole risk, that risk doesn't qualify for special form replacement cost, so that coverage won't be offered on the policy. Equipment breakdown is another good coverage to have added on. Property enhancement endorsement, most of our carriers offer some form of that. Each one's slightly different, but it's also a good coverage to look at having added on. I didn't list it on here, but I'll talk about it too. Having water damage and backup coverage on there. Some carriers don't offer it at all. Some will offer it as a supplement, generally under their property enhancement endorsement, and then some of them will offer it as a sub limit, anywhere from like 25,000 to 100,000. So that is a good coverage to have as well. And then your general liability for the apartment owner is an important coverage to have. I recommend, also including hard and non-owned auto if they need it. And if they're looking for higher limits, we can do an excess liability. The max limit we can go up to on apartments is 5 million. So we have a few excess markets that we can look at for apartments. But again, similar underwriting guidelines are going to apply. Number of units might kick it out with one market, but like I said, our cap on that is 5 million. And as I stressed before, please, please, please provide all coverages you're looking for, because that will just limit the back and forth that we have to go through, and I can get you a quote a little bit faster, because like I said, I get a lot of, accords that are half completed, and there's not enough information for me to go on to be able to quote the risk. So, everything that you're looking for coverage on, please include that on your accords, or sometimes people put it in their email. Just as long as I have that information, I will be able to, be able to offer you terms. I see a question about wrongful eviction. That will also fall under your habitability exclusion. Too, and then also too, for wrongful eviction, I would recommend potentially looking at getting a tenant discrimination policy. That would be my coworker Lexi. She handles all of our professional policies. So I honestly am not an expert in that at all. So she would know a little bit more. So there potentially could be an area where that could get picked up. So if you want to talk to her about that, our website has all of our underwriters' information on there. So our names, our emails, and our phone numbers. If you want to talk to her about that, she might be able to provide some more information and see if that's something that would be able to be picked up for that coverage. Okay, so we're going to go into an example about just a multi-building apartment complex. So for this example, we have a 24-unit apartment. There's 3 two-story buildings. They're each 6,000 square feet, meaning they each have 8 units in them. They were built in 1975. There's a pool and a playground. The reason I wanted to put an example with a pool and a playground is because I need that information if they have any common area components that are accessible to all the tenants there. So all the tenants are allowed to use the pool, all the tenants are allowed to use the playground. So we have to rate for that stuff on the GL. So the GL is going to be rated on your apartments, your number of units, but also anything, like I said, like if they have a pool, we have to rate for that. If they have a playground, we have to rate for that. Maybe they have like a community area, like a clubhouse, we would need to rate for that. So all of that information is really important to know everything that's happening at that apartment complex. Some of them can be really grand and have a bunch of things. Some of them might have 3 pools. We just need the number of pools. So the number of each amenity that there is that all the tenants have access to be able to use. So with this one being built in 1975, it was fully gutted and remodeled in 2021. So for some carriers, 1975 is too old because there are markets out there who will, only write buildings that are 20 years or newer, 30 years or newer. Like I said earlier, we do have markets that will take the older buildings. I've written things as early as, maybe like late 1890s onwards. So like I said, again, it's going to vary by carrier on what's available. But in this instance, like I said, it would kick it out. But since it's been remodeled in the markets that we could go to with the older buildings, we could be able to offer you guys special form replacement cost, which would be great because that's generally what coverage most people are looking for. A building that's older that has no updates, we wouldn't be able to offer them special form replacement costs because our markets aren't looking to take that risk on. So it would have to be basic ACV. And then these are just some of the coverages that they're looking for, like what we just talked about on the last page, important coverages to be looking out for. If they don't want that, that's fine. As an insured, they have the right to pick and choose what coverages they want. So, if they want to scale back because they're concerned about pricing, because of everything that's changing in the market, pricing has obviously gone up as well. So, they may be concerned, so they want to scale back on certain, optional coverages. That's totally fine. But obviously the important things for them to have would be the general liability, insuring the building, having business income. And then anything kind of after that, I would say could be pick and choose from, depending on, maybe the insured's budget doesn't account for that. So sometimes we can make changes. We could send you a quote that has all these coverages and you come back and be like, okay, can we remove this? Can we remove this? Like, what will that bring the price down to? So I definitely get requests for that a lot. I do want to talk about other thing about the pool. because I just had the situation happen last week. For pools in an apartment, condo, wherever, we are looking for the pools to be fully fenced with a self-latching gate and there to be life safety equipment available. I just had one where it was found out the pool wasn't fully fenced. So I wasn't able to offer terms because that isn't not acceptable with our markets. So we are looking for a fully fenced pool with a self-latching gate. And like I said, having that life safety equipment available, like you can see in this picture. Generally too, it will come with signage as well, just the appropriate signage saying, like swimming at your own risk type things. Those are important measures to have in place. And that is something that will be checked on an inspection as well, which we'll talk about inspections later on in the presentation. All right, so since the last example that we just did was a three building risk, I need a breakdown of those buildings, which is why I broke them down for you, telling you how many square feet there are per building, the number of units per building. On any multi-building location, I need a breakdown. I'm not going to be able to offer blanket coverage. We don't have very many markets that will offer blanket coverage, and even if we do have a market that qualifies for that will offer blanket coverage, we still need a breakdown of those buildings because the carrier still needs to see the number of units per building, the square footage per building, the property limits you're looking for per building. So we really do need this information. So this is just an example of what an SOV could look like, a statement of values for those of you who aren't too familiar. I'll refer to it as an SOV. This is just an example. There's all kinds of formats you can do this in. Most of the time it is an Excel spreadsheet that people send over and they are just breaking down each building. And then two, if they have any attached or detached property. So any detached property could be like, maybe they have a separate laundry room that needs coverage or a little storage room that needs coverage. They have carports. If they don't have to have coverage on their carports, but it would be recommended. Those are all things that we need broken down because any component that's looking for coverage that's not attached to the building, we would need that provided on your submission in order to offer coverage. And then this is just kind of an example of attached versus detached property. So on the picture on the left with the fence, it's attached to the building. So we wouldn't write that as separate fence coverage as its own line of the policy. We wouldn't just incorporate the limit of whatever that fence is into the value of the building value. The one on the right is a picture of like a detached carport. So if they were looking for coverage for that, since it's not attached to the building and they want coverage for the carport, then we would need a limit for that as well. I see we have a question about separate policies for each building or parcel. Generally speaking, depending on the risk, if an insured owns multiple buildings but they're all together, we would want to write that as one policy. But if they, maybe they have a location in San Diego, and a location in LA, and a location in San Francisco, and they want to write 3 separate policies, we could look at doing that as well. Like I said, it depends on the carrier and where we can take a risk. But if they're like in the same parcel, especially if they all have the same address, it would all have to be written on one policy. Sometimes people will try to split it if they can. It kind of just depends, like I said, by the carrier and their underwriting guidelines. Because in some carriers' eyes, even if they have different addresses, but they're all next to each other, they still consider that like one large unit, basically. So they would want to write all of the locations on the same policy. All right. Okay, our other example we're going to go over today is a mixed-use apartment. So again, a mixed use to me has commercial tenants on the bottom, or not necessarily on the bottom, but there are commercial tenants and there are residential tenants. So in this example, we have commercial tenants on the bottom and then our residential tenants on top. So it's really important with mixed-use buildings for the commercial tenants to not only provide me who the commercial tenants are, but the square footage they occupy, because on the rating side of things for the GL, your residential part, your apartments will be rated on the number of units, but the commercial part will be rated on the square footage of that commercial tenant. And like I said earlier, it's really important giving that commercial tenant information because it will dictate what available markets there are. Like I was giving that example with restaurants, we have some markets that are like that. They won't touch a mixed use building where there's residential over a restaurant. So that's a really important information to provide. In this example, the building was built in 1929, but it was only partially updated in 2015. So maybe in this example, they only did the roof and updated the old wiring, but they've left the plumbing the same and the HVAC system hasn't been updated. So in this instance, since they've only had partial updates and because of the age of the building, we would only be able to offer them basic ACV because there's just not enough full updates for this to have qualified for special form replacement costs. And so that's, kicking it out with certain markets, because we know there are certain markets who are always looking for updates to be able to write coverage. So that's why it's really important when filling out the Accord 140, providing all the information you can about the updates, and providing the limits that you're looking for and the coverages you're looking for, so that we kind of have an idea of where we can take a risk. All right, so what's needed to get a quote? So we'll need an Accord 125, 126, and 140. Like I said, including all of the potential GL rating factors on there, so the number of units, if there's pools, playgrounds, and then 2, for when it comes to the property side of things, providing your building limit, providing your annual rents limit, the other coverages you're looking for. So all that information being filled out on your Accord forms. We do need an apartment supplemental. It's going to be something that we always need. So we can work off of other carriers. If not, ours is, we have ours on our website that you can go to. Our website information will be at the end of the webinar. And our website is a great tool to go pull all of our supplementals from. Like we talked about, the statement of values, we'll need that if there are multiple buildings at one location. I will need that breakdown. If it's just one building and maybe a carport, I don't necessarily need an SOV, as long as if you're looking for coverage for that carport, you just throw that on the Accord 140. That would be great. I need 5 years loss history. It's really hard these days to quote a risk subject to favorable loss history, just because of where the industry is. Most of our markets aren't wanting to touch anything without providing them loss history. Sometimes I know it can take a while to get that from, the previous agent if you're not the agent of record on the account, or the insured doesn't want to provide it, but it is extremely important that it is provided, especially if they've had losses. We need to know all the details about the losses. So if you've done business with us in the past and you've sent in a risk with loss history, I'm sure you've gotten an email asking, for additional information about the losses. So we need to know what happened, confirm if the damages have been repaired, and we also need to know what actions they took to try and prevent that from happening again. So, maybe on a loss runs, we see that they've had 3 water damage related losses in the past 2 years. Why do they keep having those water damage losses? So what actions are they putting in place? Are they hydrojetting? Did they decide they're going to repump the building? What are they doing to help try to prevent those losses from occurring again? Because loss history is a major thing too that's affecting market availability. We have some carriers who are, if a risk has, more than 2 losses, regardless of size, or, that they're not going to want to touch the risk at all. So it's really important to provide everything that you can, so I can try to best sell the coverage to you on your behalf to the carrier. So, I have to be able to provide them a story. Things with open losses we can look at. It really just depends. So on those ones, another thing we'd be looking for besides the other questions I just asked is, if when it's still open, is where are they in the claims process? Have they begun starting to repair those damages? Are they just waiting for the final payment from the carrier to be able to finish out the repairs? Where are they in that scenario, so that we can, again, explain that to the carrier and hopefully be able to get them to offer us terms. The last bullet point on target premium and expiring premium, these days, I know it's not really something we're going off of because of, like I said, so much of a premium increase, but if you want to provide that information, that's great. Or maybe if you have a quote already on that specific risk for the, their upcoming renewal, and you could let me know what that premium is, and I could kind of let you know if it's something I think we would maybe be in the ballpark of. I see we have another question, a couple questions actually. Let me see, give me 1 second. So for, owners with older buildings, how are they supposed to know the updates if they, purchased the building recently? Sometimes that information is given, at time of escrow, as part of like their packet of information from the previous owner, having them disclose what information is available. excuse me, and on updates, so sometimes you get lucky with that, or so they've been able to chat with the current owner to the new owner to be able to get that information. They can also see with the city or maybe the county, depending on where the risk is, if permits were pulled to do updates. So I know sometimes it is harder on those older buildings, especially if you're a newer owner and you weren't provided with this information. Um, Sometimes people will have like a roofer come out, an electrician come out and kind of do give them a rough estimate of maybe when things were updated or the condition of the things. So that information for us when it comes to updates, so I mean, our carriers aren't looking for permits or anything like that, but they are looking for the year of updates. So if they're not sure and it seems like they probably haven't been updated in original, then we probably would still be able to help them. It just wouldn't be on a special form replacement cost basis. It would most likely be on a basic ACV basis. And then let's see. Restrictions on circuit breakers. Great question. Yes, there are restrictions on circuit breakers. That is a pretty standard question that we ask as part of our submission process. So if they have Federal Pacific, Zensco, Challenger, fuses, knob and tube wiring, aluminum wiring, I'm leaving out some, but you kind of get the gist of it. For the most part, those will be prohibited with our markets. I do have one market that is able to consider Zensco and Federal Pacific panels. However, their underwriting guidelines can be pretty strict. So it really depends on the risk and if it's something that would qualify with them. So if you have a risk that has that, feel free to reach out and I can let you know if it's something I would have a market for. Otherwise, for the most part, like I said, it's not, those types of panels would be prohibited with us on both a property and a GL basis. And then, let's see, the last question we have here before we move on, what if it's a new building and they don't have the years? Are we saying I'm new as in like newly built? So if it was built within like the last 20 to 25 years and they don't have any updates, that's pretty understandable. And most carriers are still going to be able to offer, special form replacement costs. Generally, it depends on the carrier, but I would say anywhere from 25 to 35 years is when carriers are starting to, now start looking for updates. Oh, all right. See, they clarified on the 5 years loss history. Yeah. So if it's a newer purchase, or let's say they purchased a building 2 years ago and they don't have that previous loss history from the previous owner, which I'm not expecting you to obtain in any form, that's fine. Just provide loss history for the time that they've owned the building. So if they've owned the building for less than 5 years, then there's not 5 years loss history to provide. All right. All right, and just some other things that we talked about that would be important information for us to have as well as for us when we're doing our quotes and working on the submissions for you guys. Confirming any vacancies, that's a question on our supplemental asking you what the vacancy percentage is, because that can affect what carriers will accept the risk. The type of plumbing is really important. If there's copper plumbing, PVC, galvanized, that will affect. If you have galvanized plumbing in your building, even if your building is, updated and could qualify for special form replacement costs because of that galvanized plumbing, our carriers that were able to take the risk to would automatically make coverage be basic ACV. We talked about the electrical and the wiring. The rent roll and tenant list, that would be important if like I said, you have a mixed use building and they have multiple commercial tenants in the building, that would be helpful as well. Sometimes I get them too on just apartments and a rent roll of the tenants who are in the building. So I'm looking for more of on the commercial side of things, but if you have one and you want to provide it, be my guest. One other thing I want to go over is the importance of the building limit. I have so many people ask me all the time, how do I come up with the building limits? So these are my suggestions to you. If you're able to, I know some people have a system where they can do it, or sometimes they have a carrier that does it for them when they put in a risk and it will generate a replacement cost estimator. So I definitely recommend that if you're able to. There are some free ones online. Sometimes I'm not sure how accurate they are, but just to give you an idea of where to start. If it's a new client for you that has existing coverage, you could always look at their current limit and kind of base it off of there. You might think maybe their current limit's a little low, but that's at least a starting point for you, and you can always offer something that's a little bit higher. I will say though, do not base your limit on the market value. So your building could be a market value of 5 million, but in reality, your replacement cost value could only be 3 million. So it's really important to base it on the actual replacement cost of it, not the market value. All right, and then it looks like we have another question about the target premium. Why companies ask for this. Some companies ask for it because they're, wanting to see if it's something that they would even be in the ballpark of, maybe they've kind of done a rough rate up of the risk and they're before they continue on and maybe ask more detailed questions about something just to be like, hey, this is where we're at. Is this like anywhere within the insurance budget or what they were looking at, or do they have another quote on the table that's less? Because then that kind of helps them, not continue to waste their time and continue on with, quoting the risk or passing on the risk if they need to. All right, so one last thing before we wrap up, the bind and post-bind requirements. So this is really important. So, we've made it through the whole quoting process. You guys got a quote. You've met with the insured and they're ready to move forward with coverage. So where do we start? I get a question all the time. What do you need to bind? It's a regular question I get. So when we send out a quote, we will send out the quote with our quote cover sheet on there. So on that first page, you'll see a section that says items needed prior to bind. Everything that is listed in that section is what is needed to bind. So, if we need signed accords, we need a signed supplemental, we need the currently valued loss runs, we need a mailing address, whatever. Any information that we need will be listed on that section. So it's always important to review those items. If then you have a specific question about one of those items, feel free to reach out and we'll be happy to, clarify with those. For the bind docs, they need to be signed by the insured. You can sign them, if there's a spot for the agent to sign the app, that's great. You can do that as well. But for us to be able to accept them and bind coverage with the carrier, they have to be signed by the insured as well. We can accept digital signatures as long as they're verifiable. So, Adobe Sign, DocuSign generally either puts a stamp on there or spits out like a verification page. As long as we have that information to prove that it is a verifiable digital signature, then we can accept it. Sometimes when we get them where they just straight up look like they were typed with Word or something, we'll have to go back to you and either ask you to provide the verification that they signed it digitally or make you have to unfortunately go back to the insured and get them to sign with a wet signature. Your inspection contact information, if that's not already included on the accords or somewhere in the supplemental, that is something that we will need because for the most part, I would say 99.99% of our apartments will be inspected. So providing that information is really important because the inspection is extremely important in getting done. Because if the inspection doesn't get done, then the carrier is going to be forced to issue a DNOC for not complying with that requirement of the policy. If they have any additional insureds that need to be included, so like a mortgagee or a lost payee, if it's not already included on the accords or anything like that, please provide their name and their address. If they have a management company, generally we don't list them as additional insureds on the policy for an apartment because they are automatically included on who is an insured by definition of the policy. That may vary by carrier, but for the most part, your AIs on an apartment policy are going to be a mortgagee and lost payee. Payment. Collecting payment is really important, obviously, because if we can't collect payment, then we'll have to cancel the policy. So depending on the carrier, payment is generally due with either in 20 or 30 days to our office. So like I said, that varies by carrier. So your invoice and your quote will have those specific terms and we'll let you know when payment's due. It's definitely recommended that if, when you're meeting with the insured to get the doc signed, to at least collect that 25% down, even if they're not financing. So you can at least cover your basis in the event for some reason they don't pay the rest of the policy or the policy canceled, because we don't want you to be out of pocket of money because, we'll have to get that 25% regardless because that is requirements. We do have some carriers that require payment at time of bind. Again, that would be listed as a binding subjectivity. We just launched, well, not launched, we have had it for a while, but now it's free to our agents. We have our ACH paying online system where you can make payment. So there's no fee if you pay as ACH, but if you do pay with a credit card, there is a 3.5% charge. So, make it a little bit easier for you guys to be able to put payment through. Payment needs to come from you as the agent. We don't accept payment directly from the insured because they're not our client. You are our client. And two, if the insured paid us directly, you would have to be waiting for your commission. So that's why we don't accept payment from the insured, because on an agency bill policy, you will collect the premium from the insured and then just remit the net amount to CID and retain your commission at time of bind. I talked about getting the inspection contact information. Once we have that, we'll send that through. The carriers generally within about a week or so of getting a policy bound, will already get the inspection information over to the inspection company, and then have that inspector be reaching out to the insured to get that inspection scheduled and completed. If the inspector is having a hard time getting in touch with the insured, they'll reach out to us, and then I'll reach out to you so we can try to bridge the gap and get this taken care of. Because again, if they don't complete the inspection, then the policy is subject to cancellation. And then one last step after, so we've gotten the inspection scheduled, it's been taken care of, it's been sent back, it's been reviewed. Now there's loss control items. So then those would need to be addressed. Depending on the carrier and what the loss control items are, an automatic DNOC could potentially be issued, especially I'm seeing it a lot on electrical panels right now, where somebody said, oh no, they don't have that type of panel, but then the inspection comes back and it's clear that they do have that panel. So, certain carriers are automatically getting off. Other ones are, allowing the insured to try to be able to fix that measure and get a new panel installed, which I know these days can be really difficult because there could be a backlog depending on where you're located, and having to get permits and potentially having to have the power turned off at your location to be able to have the panel switched out. I mean, it can be a process, which we understand. So, as long as you're providing us with information, giving us a timeline, maybe showing us contracts of where they're at with things, we can work with the carriers to try to give extensions to allow these items to be completed. So that way, an insurance policy doesn't get canceled because of loss control and not being able to complete what's required by the carrier to be able to remain eligible for coverage. All right. Sorry about that. If you guys have any other questions, feel free to drop them into the chat, or you can shoot me an email too as well if there's something you want to discuss. And then, like I said, on our website at cidinsurance.com, we have all of our supplementals on there. All of our past webinars are on there. If you are new and aren't really sure how to fill out Accords, we have one on Accords. I do send a lot of people that one, and they find it really helpful because there is a lot of information on Accords that is kind of useless to us. So, we highlighted over what was needed. My contact information here as well. If you want to give me, shoot me an email or give me a call if you want to talk about something. And then feel free to send your submissions to submissions@CID Insurance. If it's not a submission for me, it's good to send it to that general email because it will get logged to the appropriate underwriter in our office. And then you'll get an acknowledgement email from that, and then you can go from there to contact the appropriate person. But if we don't have anything else, thank you guys for attending, and I hope you guys have a great day.